Few things are more satisfying than growing your own garden. However, as any gardener will tell you, it's not a matter of luck. It takes strategy and it takes management. And the same can be said of growing a good retirement portfolio. It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. If you're a regular viewer, you know that I have almost an infinite number of ways to explain the practical value of investing for income. One thing I mention frequently is that it gives you the potential opportunity to grow your portfolio organically. As we'll learn today, this can be an effective alternative to relying on traditional growth-based financial strategies, particularly during retirement and in the transitional years leading up to retirement. But what do I mean when I say organic portfolio growth? Why would it be a better option for achieving your retirement goals? And just how do you go about doing it? We'll answer those questions and more on today's show and explain how organic growth works regardless of whether you want to significantly lower your risk or whether you want to stay in the stock market game. And joining me, of course, will be my good friend and co-host, Jeff Small, along with our friend John Najarian, co-founder at MarketRebellion.com, along with Sam McElroy, a Chicago-based financial advisor who's part of the Retirement Income Store. But first, let's talk more about what organic portfolio growth actually means and when it can become useful. We all know that life moves in stages, right? One of those stages is young adulthood. When you're getting started, you're establishing your job. This is the growth and accumulation stage of life. You're accumulating possessions, new friends, often starting a family. In addition, you're starting to grow your money and save for the future. And chances are you're not actively thinking about retirement yet because it's still far, far off. And you're not really thinking about the need for retirement income because you have a reliable source of income through your career. So in terms of investing, all you really care about is that you're accumulating a bigger and bigger pool of savings and that your nest egg is growing. Based upon what you hear from much of the financial media, you believe that the best way to grow your money is by investing directly in growth-based stock market strategies that offer the best possible return. You really don't care whether that return comes in the form of capital gains or dividends, just as long as your savings is growing for the future. However, starting somewhere in your 50s, you begin moving into a new stage of life. This is the transitional stage, where it's time to start thinking about how to best convert the savings you've grown into a reliable source of income once you've left the workforce. That's when it becomes crucial to understand this formula. This formula illustrates that total return is a sum of both growth plus income. And that's important because whereas growth has been your top investment priority during the accumulation stage, income will soon take over as the top priority in the income stage. Now, is there an absolute need to stop investing in stock market-based strategies once you enter the transitional stage? Of course not. Every case is different. It depends upon your personal situation, your goals, and your risk tolerance level. However, there is a need to fully understand this formula of TR equals I plus G. There's also a need to realize that by shifting your strategic focus from growth to income, from the G to the I, you can achieve a more practical, reliable form of portfolio growth, one that's better suited to the transitional and the income stages of life. And we call it organic growth, which we'll talk about more coming up in just a bit. Right now, I want to bring in my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. He's also the brand ambassador for the Retirement Income Store and the Amazon best-selling author of the book, Turning Financial Planning Right Side Up. But we also want to bring in a very good friend of the income generation, and that's John Najarian, co-founder of MarketRebellion.com and co-author of the new book, Follow the Smart Money. John, as usual, it's my pleasure. Thanks for being here.
My pleasure as well to be with both of you. Thank you.
So, okay, I've got to, I asked you this 3 months ago, when we were pretty much in June, we were 3 months out of the market lows from the pandemic. And I said, back then, were you surprised that the market had recovered? And you said, to the extent it had at that point, and you said that you weren't. Well, now the market has hit new record highs. And for a while, it was hitting new record highs like almost every day. So I have to ask you again, are you surprised now the extent to which still there being some uncertainty out there, the extent to which the market has hit new highs?
And I'm still not really surprised, Dave and Jeff, and the reasons are several. Obviously, the Fed and the Congress, at least up until May, the Congress was participating. They haven't given us another stimulus package yet, but Congress and the Fed were both very supportive of the economy. And given what happens during those shutdown times, none of us were really surprised to see people, sectors in particular, that didn't have to touch people directly, that didn't have to be involved in hospitality. Obviously the tech stocks, we weren't surprised to see those catching a bid. Now I think it's a question of people have become addicted to many of these tech stocks, not only to trading and investing in them, but also they're on these apps all the time. I mean, everything from Hulu and Netflix and Disney Plus to the Target, Amazon, Walmart. Walmart just came out with their version of Prime to compete with Amazon. Target has its shipped version as well. And I think that just continues, guys. I think people just get used to something. They stick with it. We've seen how that works with Zoom, that people just love the app once they're familiar with it. And it's really tough to pry them off of those apps. And then you get that multiple expansion from all of that traffic being driven in one direction.
Yeah, absolutely. And that's what we're seeing now. And so I guess with over 25% of the S&P being based upon, the big seven, I guess it's no surprise to see the S&P hitting new highs also because the way it's weighted toward those tech companies. Jeff?
John, we're getting a lot of questions from our clients about what's going to happen on November 3rd. How is the market going to be impacted? Help our viewers, help our listeners shed some light on that because we're really discussing how to develop organic portfolios today. And so a lot of people are worried about what's going to happen either way, no matter who gets elected to the markets. And so shed some light on that if you can for our viewers and our listeners on what they should be preparing for, what they should expect potentially.
All right. Well, you guys are right at the center of it, both of you two, because anything in Florida is going to be a big part of who gets elected this November 3rd, or it might even take till December 3rd, who knows. But the Vice President Biden has said that he will increase taxes, although he keeps saying only on those that make over $400,000 a year. I think the market is nervous about that because increasing taxes on corporate and increasing taxes on folks that make over $400,000 a year is something that makes the market nervous. So the more that we would see Vice President Biden moving towards President Biden, I think the market would get very nervous and you'd see a big jump in volatility as well as perhaps some sell-off going into that. But I think it's going to be not quite too close to call, but I think it's going to be extremely tight. And one of the outlier things might really be, Jeff, and maybe instead of seeing all that volatility that I just spoke about, if we start seeing a movement, because of the law and order side or whichever, and I'm not trying to be political, but I'm just saying, if we start seeing people pushing towards President Trump, in particular in the swing states, which again, Florida is one of those swing states now because of the changing demographic and so forth.
John, we just hope, I hate to interrupt you, we need to take a commercial break. We just hope that we can get the voting straight this time and not have all these darn hanging chads down here in Florida. But we need to take a break. We'll be back with more words of wisdom from our good friend John Najarian in a moment. We'll be right back. I'm David Scranton. As we reopen the economy, a renaissance has begun in the world of investing. If you or your advisor are not prepared for the new corona economy, you could be left behind. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 866-853-7209 for your free retirement income kit. Call 866-853-7209 now.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
One of the most popular tools that are used by investors during the growth and accumulation stage of life is, of course, mutual funds. But why are they so popular? One reason is convenience. Once you or your financial advisor settles on a combination of mutual funds, it's up to fund managers to do the heavy lifting. Also, mutual funds offer an easy way to diversify your portfolio, which most people know is an important principle of investing. Mutual funds are comprised of a pool of investments in different companies and different sectors of the market, which theoretically helps curb your risk to a certain extent. Ultimately, though, when you're invested in a mutual fund, you own shares in a company whose business is buying shares of stocks or bonds in other companies. Mutual fund investors don't actually own stock in the companies the fund purchases. Instead, they just share equally in the profits or losses of the fund's total holdings. Also, for a variety of reasons, mutual funds are designed for more growth and less for income production. Together, these issues illustrate potential downsides of continuing to invest for growth in mutual funds during this transitional stage of life, and of course, during the income stage, retirement. One obvious pitfall is that growth can quickly turn into shrinkage when the market undergoes a major correction. We saw this in the year 2000 when the tech bubble burst, and again in 2008 during the financial crisis. When that happens, if you haven't taken steps to help ensure that you're getting your return primarily in the form of income rather than growth, you're out of luck. Your whole portfolio may be underwater, as we saw for 6 or 7 years. If, however, you've made changes during the transitional stage to make sure that you're satisfying your income need through dividends and interest, then a major market downturn isn't so devastating. Why? Because you're still meeting your income needs through interest and dividends as you wait for the market to recover. With the help of the right advisor, you can also use your dividend or interest, at least part of the dividend interest, to continue growing your portfolio through strategic reinvestment. This is known as growing it organically, growing it the old-fashioned way. This strategy can also serve as an alternative approach to dollar cost averaging, which becomes more difficult to do in the traditional way as you enter the transitional stage of life and your contribution gets smaller relative to your portfolio balance. Here's the bottom line. Because mutual funds and many other stock-based strategies are focused primarily on growth instead of income, you need to be aware of the potential risks if you want to stay growth-oriented with your investments as you near or enter retirement. You also need to understand that there is a way to continue playing the stock market game if you have the right risk tolerance, but that it still requires making a strategic shift. This is a shift that an advisor who specializes in retirement income can help you make. What's more, if your risk tolerance is lower and you want to get out of the market altogether, you can also get a competitive return and achieve organic growth from a more conservative portfolio of bonds and bond-like instruments. So what do I mean by competitive return? Well, we'll be talking about that more coming up in just a bit. Now it's time to bring back my co-host, Jeff Small, as well as our good friend, John Najarian. So John, sorry I had to cut you off for the benefit of our sponsors there a moment ago. I agree with you. I understand the concern the markets might have about taxes going up, but how about the other part of it? How about the fact that Congress wants to allocate, $3 trillion, not just $1 trillion. They want to, they want to have much more money going to stimulus Now, for the average American, can that maybe somewhat counterbalance this tax concern in case of a Biden win?
Well, as you know, we're going to have to find a way to pay for any stimulus that we put out there. Now, obviously, what they will do is issue bonds, and I'm all in favor of issuing bonds at the lowest interest rate, at the lowest borrowing rate that we've seen in anybody's lifetime. That makes sense. If we do it in a prudent way, and if this was infrastructure, not just a gift to cities and states maybe that have mismanaged money, then I think it could be very strong, for instance, David. But I worry that the direction that some of the people in Congress might take is just to throw that money out there and or to bail out bad decisions that cities and states have made. And I don't know that that helps us. I think that really hinders us. And then we risk downgrades by S&P and everybody else, basically all the rating agencies around the world.
Sure. You don't want to be rewarding irresponsible behavior even by municipalities. Jeff?
Well, besides the tax plan that Biden has laid out, which is increasing corporate rates from 21 to 28, which would be an 8 to 12% reduction in earnings, I think that would be a disaster for the market. But there's even a larger undertone here that's scaring people, and it's called socialization. I mean, just imagine what happens if the Congress goes blue and the White House goes blue, and they're going to pretty much be able to push through any socialized programs they want. The markets are not going to react well to that environment, and that's really what's scaring people the most. What are you seeing up there? Is anybody discussing this, in New York or in your group?
You're exactly right, Jeff. That is what people would worry about. They wouldn't worry as much about a Biden presidency if the Republicans held on to the Senate and or made some gains in the House. Then it would be more of that, balance. But if it was a blue wave, that's the worst thing that the market could envision right now, is that blue wave. I don't think we're going to get it, and the reasons are myriad, but one of them is the protests that have gotten so violent in Portland, in Seattle, in Washington, D.C., in Kenosha, in Chicago, in New York City. I mean, it's all over the place. I think a lot of folks, in particular suburban moms and dads, are not going to be down with that. And so I think, Dave, that's one of the things that maybe helps keep that from being a blue wave. And I certainly hope it does, because I think that would be a disaster, both for the markets and for America.
Sure. And John, we have a little bit less than 2 minutes left. So since we're talking about income reinvestment and growing portfolios organically, I want to talk a little bit about options. For example, if we're investing in the stock market, we're investing in higher dividend paying common stocks because it's all about income. It's all about yield. And of course, you can write covered calls on those and kick up the income, as we do for some clients. But how about the tech stocks that you're talking about? I mean, it's kind of harder to do that with a lot of the technology companies, is it not?
Well, and that's one of the good things that has just occurred with that big tech correction that we saw, even though it only took 4 days or so to get to a full 20% correction in the case of Apple. Even more than that in the case of Tesla. And I'm calling Tesla a tech stock. But the good thing about that is that it caused the stocks to get cheaper quickly and the volatility to go up, Dave. So you're getting rewarded for selling those calls even more now. So I think your income generation folks are going to appreciate that. And yet these stories are still the same about Microsoft, Facebook, and Apple.
20 seconds. Do you think we're at the point of rotation now out of tech into more traditional cyclical companies, or do you think it's still too premature?
I think that doesn't really start happening until first or even second quarter of 2021, Dave. So I'd say you have a little time. You could start nibbling, but don't go whole hog on that yet.
Okay, so it's basically a balk. The pitcher balked. We saw a little rotation a couple days. Might go right back to tech. As usual, John, thanks so much. Incredible words of wisdom. Thank you.
Thank you, sir.
And you stay with us. We have more coming up right here on the Income generation. I'm David Scranton, and we'll be right back. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
Call 866-710-1749 to receive your free retirement income kit with 5 educational tools and a no-obligation conversation with an income specialist. Call 866-710-1749. Online at theretirementinComeStore.com.
The Income Generation is now available on YouTube. Subscribe to The Income Generation so you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to The Income Generation, only on YouTube.
We all probably know someone who is so distrustful of the entire world of finance that they're reluctant to even put their money in a bank. And given what happened during the financial crisis, it's hard to blame them. Plus, the reality is that putting your money in a bank or any money market fund these days is really not much different from sticking it under your mattress. Sure, you have all the liquidity you want, but with most bank accounts generating less than 1%, you certainly won't be growing your savings. In fact, when you factor in inflation over time, you'll actually be losing money. Most of us know this. We understand that our money needs to be generating a much better return in order to be growing and to be working for us, as we like to say. And that's why most people opt for things like mutual funds during the growth and accumulation stage of life. They've been told that historically the stock market can be counted on to give them the best return, as much as 9 or 10% over the very, very long run. And that does sound good, but there is an important caveat to that popular notion that every investor needs to understand. It's that based upon certain long-term market patterns and long-term market cycles, the very long run for that kind of return is typically 30 to 40 years, statistically speaking. That means that if you retired at 60 in the year 2000, and you put everything into mutual funds and other growth-based investments, you'd be age 80 today, and you'd still be looking at another 10 to 20 years before you can be statistically certain that you'll realize your average return of 9 or 10%. Thanks to those 2 major market corrections I mentioned before, your average return until now has probably been closer to 5%. More important, most of that return has come in the form of capital appreciation. That means when the market sank during those 2 corrections, most or all of your portfolio was probably underwater, and you may have struggled to meet your income needs. By contrast, many income-based investors since the turn of the century have also managed to achieve returns in the same 5% range or higher. However, enough of that return has come in the form of interest and dividends to satisfy their income needs, so that in their case, their accounts were actually allowed to recover when the market recovered. This means that throughout all the market chaos and uncertainty over the last 20 years, they've been able to continually meet their income needs, achieve their retirement goals, and grow their portfolios organically through strategic reinvestment. Now it's time to bring back my good friend and co-host, Jeff Small. So Jeff, were you surprised by any of John's comments per se?
I was a little shocked, but not in complete surprise, of his comments on the blue wave, which seemed to be dominating a lot of the concerns about what investors should do going forward, post the November 3rd election. If we see a blue wave in Congress and we see a blue wave take over the White House, Dave, there's some real concerns there about what could happen. Is that going to undermine the free market, capitalism? I mean, this is an area that I know you don't like to delve into because you're always apolitical. I'm a little extreme towards the opposite of apolitical. But tell me what your thoughts are in that regard. Are you seeing clients have concerns, and our viewers and listeners should be worried about that at this time?
Yeah, I mean, there's some clients that have concerns, just like I had some clients brand new clients from 4 years ago that literally right after Trump was elected, they came in Connecticut, being a blue state, and basically said, get me out. That's it. Get me out of the market. Trump's president. And of course, in retrospect, if they stayed in the market, they would have done great, right? But I think it's more the insiders on Wall Street. It's big money that probably has John's concerns more than just the average individual. And sometimes, trends change because the average investor, like when they had the tech bubble in the late 90s, is buying, buying, buying. But sometimes trends change by the insiders. And then all of a sudden, there's a sell-off, and that creates, by the insiders, it creates panic selling by the average investor. So sometimes the dog wags the tail, and sometimes the tail wags the dog. But I do believe John was more concerned about those Wall Street insiders more than anything.
Yeah, I think that's definitely an area of concern. But he also mentioned that the Biden platform wants to raise corporate taxes from 21% to 28%, and so everything that I've researched shows that would affect earnings to the negative. Earnings would drop in corporate America on the S&P 500 companies from 8 to 12% annually. That is a serious shot. You know what that's going to do to fundamentals? It's going to raise the price to earnings ratio because stock prices are already elevated.
Yeah. No, that's bad. That's bad. Just like we got the Trump bump, just on anticipation of him lowering corporate rates. The stock market had a great year going back just a few years. And the same thing could very well happen in reverse. And that really is material. But what I found to be most interesting was, talking about when the tech stocks are really going to, right now it's been a big tech rally and a lot of other stocks are still out of favor. And, I get nervous because I feel like, that rotation is going to occur anytime from tech into the more cyclical companies, the companies, that have been around for decades and decades that our viewers and listeners know and oftentimes have in their portfolios. But he said, we've got probably at least 6 months before that happens. That was surprising to me.
Yeah, I don't know why he said that, Dave. I think that's a mistake. I think if you're going to be a common stock investor, the undervalued portion of the market is in the cyclical components. That's the place to start positioning now. Don't you agree? I mean, we've designed portfolios on that basis.
Well, you got to get, you always got to get there early. So timing's never going to be right. Whether somebody's getting out of the market because the market's high, you're better off being a little early than a little late a lot of times. And same thing, if you're getting in the market sometimes, if you're making the rotation, you're better off being a little early. One question I wish we had asked, I'd be interested to see his answer, is, how much higher the tech stocks would have to go before we have another 1999, before we have a tech bubble of sorts. What's your take on that? John's not with us anymore, right? We sent him back to his office in Chicago or New York, wherever he is today. What are your thoughts about that? How close are we to another tech bubble bursting, or is this a whole different scenario now in your mind?
Well, there's been some rumblings in the financial press as of late, Dave, that the next 5 to 10 years are going to be anemic. We're not going to see really any growth in the markets because of the peaks that the markets are at currently. So you really have to have a much longer term perspective in the world of tech, since the valuations are at their all-time highs. And even companies like Microsoft and Apple, they're at their all-time highs. They've never been this high. So what's going to push them higher? The only thing that's going to push them higher is if they improve the bottom line. Their net earnings have to increase. But if we turn blue and corporate tax rates go up, what happens to their bottom line? Their profit starts to drop because they're paying more in tax. And so I think it's a dangerous time to be a tech investor, even with the 10% pullback we've had recently.
Yeah. The tough part is people are making so much money with the tech stocks today. And, the rally can continue, right? Like we always say, when the market's going down, it always goes, further down than you expect. Of course, assuming there's no intervention like we had back in March. And when the market's going up, it tends to go up longer than people expect. So, who knows? At bare minimum, though, investors can hedge, right? If they want to be in tech stocks, they can hedge. They can use put options and things like that to protect, or stop losses to protect themselves on the way down, right? At least maybe that's the way they can have their cake and eat it too, if they still want to squeeze a little more juice out of that tech market.
Well, that's a pretty sophisticated realm for individual investors to work in. They kind of have to be a student of the markets and a student of options. That's not something that we do for our client accounts because it's pretty complicated. Folks won't understand that. But there's always an option there to hedge. But the best hedge, Dave, is income-producing assets that are uncorrelated to the market indexes. And so we want to disconnect with a portion of the funds, from the market indexes.
Well, we have Sam McElroy coming on in just a moment, so it'd be interesting to see what he says about that and about hedging. So stay with us. We have much more to come right here on The Income Generation. We'll be right back. I'm David Scranton. When it came time for my mom to retire, one simple mistake forced her to work years longer than she should have. And that's why I started the Retirement Income Store, to help hardworking Americans 55 and over plan for the retirement they deserve. I couldn't help my mom, but maybe I can help you.
Call 866-314-7227 to receive your free retirement income kit with 5 educational tools and a no-obligation conversation with an income specialist. Call 866-314-7227. Online at theretirementinComeStore.com.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Perhaps the main problem with trying to grow your savings by investing directly for growth after a certain age is that it's based upon a flawed concept of retirement planning. It proposes that the idea is to build a huge pile of money that you can draw from to meet your income needs, confident that market forces will keep replenishing those withdrawals reliably enough so that it will last you your entire lifetime. While that is one way to do it, in my experience, it's definitely not the best or the most secure way. It devotes too little to strategy and leaves too much to chance. The better concept, I believe, is to think of your savings not as a resource you draw from, but as a mechanism you help protect and maintain so it can reliably generate income, interest and dividends that you can't outlive. With the right strategies, you can count on to generate this income, these interest and dividends, at a competitive rate. In fact, these strategies have many advantages over trying to engineer income by selling shares of a mutual fund or a growth-based investment over time. The bottom line is that if you want to stay in the stock market as you near retirement, yes, you can do it, but you still need the right income-centric, dividend-based strategy. You also need to keep in mind that dividends can be cut or discontinued. We saw this as recently as March. If that concerns you and you want to get out of the market altogether, you have plenty of options for doing that as well, in the form of more conservative, income-based strategies. Now it's time to bring back in my good friend and co-host, Jeff, as well as our good friend and our next guest, Sam McElroy. Sam is a partner at Stride Financial, a retirement income store located in Chicago, Illinois. Sam, thanks so much for being back on the show.
Absolutely. Thanks for having me.
So what are the biggest questions that you're getting today from your clients? Given what happened with the market 6 months ago, what's going on with the markets today? Talk to us about what you're hearing.
Well, I think the biggest question people have is just how to make sense of it. I don't know if I've ever recognized a period in my own life where there's been such a disconnect between, market valuations and just the overall experience in terms of the economy and what the average investor is maybe going through. So the biggest question we're getting is just what should they be doing? A lot of clients have some cash and they're wondering where to deploy it. And I think that that's the question that a lot of people are trying to answer right now is how do you make sense of a world that for a lot of people just is making less and less sense?
So being part of the Retirement Income Store, I know that you're talking to them about going from the G to the I, from growth to income. But you find today that more people are interested in income from contractual investments, bonds and bond-like instruments, or with the market roaring, are they more interested in higher dividend paying common stocks so they can still be in the game, still get a little upside if it keeps going?
Yeah, I think it's a little bit of both. I think that people are more familiar with dividend common stocks, but when you talk to them about the world of income generating strategies that goes beyond just dividend equities, people are very interested in being able to have things that are more contractual in nature also. I think what people really want at the end of the day is the assurance that they're going to be able to live off of the production from the resources that they've accumulated. And so when they see an opportunity to be able to, budget the way they would off of a salary by having consistent income being generated, then yes, they can still throw in some of the flavor from having some dividend equities where they can get some of that growth as well. but I'm finding that people don't really want to risk the upside if it means they may blow it and miss the ability to have the income they're looking for retirement.
Yeah, Sam, I'm hearing a lot lately about people calling me up, just clients that already have great income producing portfolios, and they're saying, what's going to be the effect of the election? If some, what's going to be the effect on my money? And is there anything that we should do now? Because there's this perceived notion with Biden wanting to raise taxes. If he raises the corporate rate from 21 to 28, it's going to cause an 8 to 12% reduction in corporate earnings, which of course will affect the market. But what are you hearing the same thing up there in Chicago, in the Chicagoland area? Because I'm hearing that down here in Florida every day.
Yeah, I would say it's a little bit of mixed. Truthfully, I think one of the things that's interesting about this election, and maybe it's true of every election, is just the amount of psychology and emotion that's connected to it. I think that it's more so about the perception of what either administration being in the office may mean. And I don't know if we know specifically right now what impact that may have on the market. It's going to be very divided based off of who you're in favor of. But one of the things I think that's really good about when you invest for income is that even if the market were to fluctuate, even if market values were to change, it's not that information is irrelevant, but that that's not where the return is really coming from. So to the degree that you can have a contractually obligated cash flow from dividends and interest and other cash distributions, that at least gives you a baseline, even if you have some uncertainty as to what's going to happen with the market value.
Right, either way, bottom line is it's not going to affect your lifestyle. And Jeff, we got to be a little careful with the political questions here because remember, we're on a very conservative network here, and Sam is from Chicago. Okay, so I'm just saying, but we need to leave it there. And
these are all stated facts. This is not the fake news. Okay, Biden's plan is to raise taxes from 21 to 28.
We need to go to break. Will somebody shut up my co-host, please? These sponsors are paying good money for this. We're going to break. We'll be back in a minute more with Jeff Small and Sam McElroy. We'll be right back. Welcome back to the Income Generation. I'm here with two very good friends, of course, our co-host Jeff Small and today's guest, Sam McElroy. So Sam, thanks so much for sticking around.
Absolutely, thanks.
Now, because of all the I heard right before the break some psychobabble from our other studio there with Jeff about fake news or something. So Jeff, since I cut you off the kneecaps for our commercial break, I'm going to hand it right back to you.
Well, Sam brought up some really good points about, who your persuasion is politically and how it's going to affect the markets. But the reality is what we see happening going forward is it's probably going to be relatively benign with our clients, even though there's an incongruity in politics and the markets are obviously incongruent with what's happening with fundamentals, as you had pointed out before, Sam. So all we can really do right now at this stage is be the anchor. But if you're in fixed income investments and you have the right portfolio, it doesn't really matter who gets elected, is what you were saying, Sam, before. Isn't that correct?
Yeah, I'm thinking right now, I have a couple that I'm working with, and they're probably about 7 or 8 years from retirement. And when they first came to us, I remember just the anxiety that they had because they didn't really see a way that they were going to be able to get to where they felt they needed to be. And like many people, they thought that they just had to throw caution to the wind and be as aggressive as possible because they were trying to make up for some lost ground. But when we actually came back and we ran the numbers and we looked at it, you can utilize income as an organic growth model. Just by generating income but reinvesting the income, that over time can actually produce the same effect as market valuations growing or anything like that. And in their case, it actually was enough to get them towards the goals that they need. And they'll already be in a position to naturally transition from going from their employment income to living off of the income produced by their resources. Now, in the same ballpark, it could be that the market has a great 7, 8 year, 10-year run, but we don't know. So when they looked at it, they said, well, why would I bet that everything aligns and everything goes great and the market appreciates when I know that I can take a more contractually guaranteed route and have an organic growth model? So I think that's the level of where income generation can really play, even when you're building towards a goal.
Great points. Couldn't agree with you more. Dave, how do you feel about that?
Well, and I think the other thing too is if you, so I'm going to speak to our viewers now and their beliefs, I think, en masse. So if we did have a Biden presidency and we did see a big jump in corporate tax rates, that should mathematically cause the stock market to go down. And the good news about that, if people are investing in dividends with common stocks, is now if they're at that stage, that transition stage where they're reinvesting all the dividends, they're actually happy about that because now their dividend reinvestment is buying them more shares. I mean, the same is true when they reinvest in fixed income, but just it a little bit less so because we don't usually see the big drops in fixed income as we can in the stock market. So, Sam, what else are you telling your clients today when they come in and they're maybe nervous about what they see out there? What's your best advice for our viewers, for our listeners?
Yeah, I think what I always go back to is strategy over product. You know what I mean? I think so many times we feel like if we want to reach our financial goals, we have to have the highest rate of return, the best product. But there's a difference between, actual returns and average rates of returns. And what I always tell people is that if you have a good plan and if you have a good strategy, that will always typically be a bigger determining factor on whether or not you achieve your goals than simply if you pick something that's perceived as having a higher rate of return at the moment. So when I'm sitting down and talking to people, what I'm really encouraging them to do is to make sure that they understand first where they are. How much income do they need? How much are they producing? How much risk do they want to take? How much are they in the market right now? And then start to massage the portfolio so that it's in alignment with all the goals that they have and what it is that they're looking to do, and only take risk to the degree that you've already covered the basis. And when you can start to align things fundamentally from that perspective, it can take a lot of the anxiety and worry away and give you a clear path towards success.
45 seconds left, Sam. Is that the single biggest mistake that you find people having, that they don't have that plan? They just kind of look at their investments as a pile of money, and then they get too close to retirement for comfort and go, oh my goodness, what do I do now?
Yeah, I think it's that. And I think it's also a limited understanding of the investment world. I think people's over-reliance on the stock market as if it's the only investment around negates the opportunity for them to have a counterbalance from other asset classes that they really do need to have a well-rounded portfolio.
Mm-hmm. So it's plan and strategy over investment vehicle. I love it. Sam, as usual, some great words of wisdom. Thanks so much for being with us here on The Income Generation again. We appreciate it.
Anytime. Thanks for having me.
Now you stay with us. We'll be back here in a moment, right here on The Income Generation. I'm David Scranton, and we'll be right back.
The Income Generation is now available on YouTube. Subscribe to The Income Generation so you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to The Income Generation, only on YouTube.
I'd like to take this opportunity to thank my guests, John Najarian and Sam McElroy, as well as my good friend and co-host, Jeff Small, for joining me here today on The Income Generation. But of course, most importantly, I want to thank you, our new and returning viewers. At the top of the show, I used gardening as an analogy for this concept of organic portfolio growth. It's fitting for several reasons. One being that there are different types of gardeners. If you ever go onto your local fall harvest fair, you know that some people are in it for the prizes. They see it as a competition, just as some people see investing as a competition. They want to be able to brag about maximum returns and massive portfolio growth. However, these people are in the minority. Most gardeners don't want blue ribbons. They just want good, bountiful harvests each and every year to meet their wants and needs. And if you're that kind of gardener, how do you go about achieving your goals? Do you just plant the seeds and then pray for sun and rain? No, what you probably do is plant strategically, then put in the work to help protect and maintain your garden. You do this all while it's growing, and especially once it starts producing vegetables. That's when preservation and management becomes most critical, because if you should suffer a loss, there won't be time to replant before the fall. By the same token, most investors aren't in it for bragging rights either. They're looking to build a savings and an allocation that'll give them reliable income to meet their needs and to meet their goals throughout retirement. Period. That's why it's so important to have the right approach to saving and investing throughout all the different stages of life, especially those stages when your priorities shift from growth to income. It's also when your focus needs to shift, ideally toward a strategy designed to make income your top priority and to create the opportunity for organic portfolio growth through strategic reinvestment. Regardless of whether you want to stay in the stock market or invest more conservatively, investing for income is still the name of the game. As always, stay safe and thanks for watching. If you're close to or in retirement and you're concerned about your money, it's absolutely essential that you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.
Diane and her husband dreamed of spending their retirement traveling, but that changed when she became her mother's primary caregiver. Now her day starts before 6 a.m., helping Mom often late into the night. It's a stressful job, but Diane wants the best for her mom. Sound familiar? We thought so too. Caregiving can take a toll on your family, but the Retirement Income Store is here to help. Call 1-888-888-4176 to find out how the Retirement Income Store can help you achieve financial empowerment during retirement.